Hey, crypto enthusiasts! Today we're tackling a topic that stumps many traders. And no, it's not about whether pineapple belongs on pizza, though that's a close second. We're diving into the market's biggest teaser, the Doji Candlestick. Imagine you're at a high-stakes poker game, but instead of cards, everyone shows their hands right away. Confusing, right? That's a doji for you, the ultimate poker face of the trading world. It's the candlestick that could mean a big change is coming, or just another day at the market standoff. We're not just scratching the surface, we're diving deep into what makes these puzzling patterns tick and how they can signal major shifts in the market, much like choosing between watching a thriller or a rom-com can shift the vibe of your movie night. So, whether you're a seasoned trader or just starting out, stick around. We're about to unpack the secrets of the doji, ensuring you won't just be another confused trader in the financial fog. Let's light up those charts and get the party started. Welcome to Crypto Dominion. I'm Alison, guiding you through the thrilling realm of cryptocurrency, NFTs, and blockchain. Hit that subscribe button for a journey filled with expert insights and a touch of fun. Don't miss out. We're giving away a sleek MacBook. Like, subscribe, and leave a comment to enter. Be sure to watch till the end for all the giveaway details. Ready to dive into the world of digital currencies? Let's get started. Historical and cultural context of doji. When it comes to the swirling world of trading, few patterns spark as much intrigue as the Doji Candlestick. Picture this. A trading day begins with energy. Prices move up and down as bulls and bears battle it out. But by the day's close, the opening and closing prices align almost perfectly. This creates a doji, a candlestick with a virtually non-existent body, symbolizing a standoff between buyers and sellers. The term doji hails from the Japanese word doji, translating to blunder or mistake. This name reflects the rarity and peculiarity of a market session closing exactly where it opened, a perfect equilibrium rarely seen amid the usual market chaos. The concept of doji emerged from the ancient rice trade in Japan, where traders first utilized candlestick charting to track market movements. The evolution of the doji candlestick from Japanese trading floors to today's global financial markets underscores its timeless relevance. In a historical context, the doji represents more than just market indecision. It encapsulates the momentary balance of power in a constantly fluctuating environment. It's a poignant reminder of the delicate interplay between fear and greed, hope and hesitation that drives financial markets. Understanding the doji's historical significance enriches a trader's perspective, allowing them to appreciate not just the technical aspect of this pattern, but also its cultural and psychological implications. As global markets grow ever more interconnected, the doji remains a powerful symbol of market sentiment, providing traders across the world with a tool to interpret and anticipate market moves based on collective trader psychology. Understanding the doji candlestick. The doji isn't just a marker of indecision, it's a psychological flashlight illuminating moments of equilibrium in market sentiment. This pattern is crucial for traders because it often precedes significant shifts in market direction. Understanding its forms is like learning the language of the market. There are several types of doji candlesticks, each telling its own story. Neutral doji. This is the most basic form of doji, where the open and close are exactly the same, with wicks of equal length on both sides. It reflects a perfect equilibrium between buyers and sellers, often indicating uncertainty in the market direction. Long-legged doji. Characterized by long upper and lower shadows, this doji suggests a more significant struggle between the bulls and bears. The market explores both high and low territories, but closes at a balance, indicating high volatility but no clear winner. Dragonfly doji. Featuring a long lower shadow and no upper shadow, the dragonfly doji appears when the open, high, and close prices are the same. This pattern is typically considered a bullish reversal signal, especially if it occurs after a downtrend. It suggests that sellers drove prices low, but buyers managed to push it back up to the opening level by the close. Gravestone doji. The mirror opposite of the dragonfly, the gravestone doji has a long upper shadow and no lower shadow, with the open, low, and close prices being the same. This is generally seen as a bearish reversal signal, indicating that buyers pushed the price up, but sellers brought it down to the session's low by the close. Four-price doji. A rare occurrence, the four-price doji is where the open, close, high, and low are all the same. This pattern shows absolute indecision and flat trading during the period, often occurring in less volatile markets. Double doji strategy. When two doji candles appear back-to-back, it intensifies the signal of indecision, suggesting a stronger impending breakout. Traders often watch the next candle closely for a decisive move in either direction to capture the momentum of a potential new trend. Each of these patterns serves as a crucial cue for traders, signaling potential pauses or changes in market momentum, making them indispensable in the arsenal of trading strategies. Technical analysis and trading with doji. The Doji Candlestick is a versatile tool in technical analysis, serving as a precursor to potential market shifts. Traders scrutinize these patterns to predict whether a trend might reverse or continue. The key to leveraging Doji candlesticks effectively lies in their combination with other technical indicators, which helps solidify the trading signals. For instance, consider the scenario where a doji appears during a bullish trend. This might signal a possible hesitation in the market, suggesting that the bulls are losing steam and a reversal could be imminent. To confirm this signal, traders often look at the Relative Strength Index, RSI, or Bollinger Bands. If the RSI shows overbought conditions, typically a reading above 70, and the doji coincides with the upper Bollinger Band, it strongly hints at a potential downward reversal. Conversely, if the RSI is not in the overbought zone, the trend might simply continue. An illustrative trade example occurred with Bitcoin when it opened and closed at $55,903 after a volatile session, forming a long-legged doji. The buyers and sellers pushed the price to a high of $57,135 and a low of $54,715 respectively, but ended with no clear direction. In this context, observing the RSI or the placement of the doji relative to the Bollinger Bands would provide further clues about the next movement. If the following candle breaks below the doji's low and RSI trends downwards, it may be a signal to consider shorting the position. Comparative analysis with other candlestick patterns. The doji stands unique among candlestick patterns due to its specific implication of indecision and equilibrium. However, comparing it with other patterns like the hammer or the shooting star can highlight its distinct utility in trading strategies. Hammer candlestick. This pattern also signals a potential reversal, but is characterized by a small body at the upper end of the trading range and a long lower shadow. Typically found at the bottom of a downtrend, the hammer indicates that although selling pressure existed, ultimately buyers took control by the end of the trading period. Unlike the doji, which shows hesitation, the hammer suggests a stronger assertion of control by buyers, making it a bullish reversal signal. Shooting star candlestick. The shooting star is the bearish counterpart to the hammer. It appears after an uptrend with a small body at the lower end and a long upper shadow. This indicates that the price opened near the low, rose significantly during the session, but fell to close just above the open. It suggests a rejection of higher prices by the market, implying potential bearish reversal, much like a gravestone doji, but with a more assertive bearish sentiment. Comparing these patterns, the key distinction lies in their implications and formations. While the doji indicates a balanced, uncertain market condition, the hammer and shooting star show more decisive market shifts where control is asserted by buyers or sellers respectively. Understanding these differences is crucial for traders to adapt their strategies to what each pattern reveals about market sentiment and potential price movements. Practical tips and common pitfalls. Trading with doji candlesticks can provide insightful cues about market sentiment and potential price movements, but like any trading strategy, it comes with nuances that require careful consideration. Here are practical tips and common pitfalls to keep in mind when incorporating doji patterns into your trading strategies. Practical tips for trading with doji candlesticks. Confirmation is key. Never rely solely on a doji for trading decisions. Wait for additional confirmation from subsequent candlesticks to confirm the trend direction. A bullish or bearish candle following a doji can indicate the potential start of a new trend. Use additional indicators. Enhance the reliability of doji signals by pairing them with other technical indicators. The Relative Strength Index, RSI, Bollinger Bands and moving averages can provide additional context and help confirm the signals suggested by a doji. For instance, a doji that forms near the lower Bollinger Band with an oversold RSI could be a stronger buy signal. Consider the market context. The effectiveness of doji candles can vary depending on the market environment. In highly volatile markets, doji patterns are more frequent but may be less reliable. Understanding the context in which the doji forms, whether in a quiet, trending or volatile market, can help in making more informed trading decisions. Volume as a validator. Check the trading volume on the days doji candles appear. An increase in volume can validate the indecision and the potential for a market turn, making the doji a more significant indicator. Common pitfalls to avoid. Over-reliance on single patterns. A common mistake traders make is placing too much emphasis on a single doji candlestick without considering broader market conditions or additional technical indicators. No single pattern can provide all the answers. It's the confluence of signals that often leads to more robust trading decisions. Ignoring longer trends. Another mistake is to focus on doji patterns in isolation, ignoring the prevailing trends. For instance, a doji that forms in a long-term bullish trend might not be a strong enough signal to predict a complete trend reversal. Always consider the bigger picture. Misreading doji types. Not all doji are created equal. Different types of doji, standard, long-legged, dragonfly, gravestone, and four price, suggest different market sentiments. Misinterpreting the type of doji can lead to incorrect assumptions about market sentiment and potential price movements. Impatience and timing errors. Due to their nature, doji patterns often require patience. Acting too hastily after spotting a doji can lead to premature and often unprofitable trading decisions. Timing trades for the confirmation phase post-doji appearance is critical. These patterns, when understood and applied correctly, can significantly enhance one's ability to make informed trading decisions, ultimately improving the chances of successful trades in both stock and cryptocurrency markets. The wrap-up. The doji candlestick transcends its role as just another chart pattern, marking itself as an indispensable tool for discerning traders. It's a symbol of market indecision that, when interpreted correctly and used in conjunction with other indicators, offers valuable insights into potential market reversals or continuations. With its implication of indecision and potential change, the doji reminds us that markets are dynamic entities influenced by myriad factors. At the end of the day, successful trading is not just about recognizing patterns, it's about interpreting them within the larger market context and integrating them into a well-rounded strategy. Before you go, let's crack open the vault on our giveaway details. We're tossing a brand new MacBook into the ring, so shiny you might need shades. When we hit 50,000 subscribers, it could be all yours. Just hit like, subscribe, and unleash your best comments. The more you comment, the better your chances. Remember to ding that notification bell to catch all the updates. Good luck, and may the odds be ever in your favor. Now it's your turn to share. What's the biggest challenge you've faced when interpreting doji patterns? And which technical indicators do you find most useful to pair with a doji for the best results? Drop your thoughts in the comments below. We love seeing your trading journeys unfold. If you find your heart racing every time Bitcoin ticks up a point, you're definitely in the right place. Thanks for tuning in and geeking out with us over all things crypto. Be sure to stick around. We've got plenty more crypto wisdom and quips on the way. This is Alison's Cypherbite, signing off. Until next time, keep those digital coins stacking and your smiles cracking.